In this video, I have 5 price action patterns and strategies for you that you can trade for the rest of your life. They have been working for a long time and they will keep working in the future. So the first one is a demand zone fake out with the add-on of a stop run, a really interesting pattern that will help you understand trends and turnarounds. So when we look at this chart on the left side, you can see that the market has been falling very strongly, and then it has turned around just as aggressively. Whenever you see a market turn around that fast and that strongly, you will find a demand zone here at the bottom. The demand zone is here marked in red. And then what you want to do is you want to wait for the market to come back to this area, and you want to carefully observe how the price is reacting. The first time the price is touching the demand area, there was a very small reaction, but this is certainly not a trend reversal reaction. The market kept making lower highs here. The market afterwards came back into the lows, pushed a little bit through the demand zone, pushed below the previous lows, and is now shooting higher. This looks quite interesting, but as long as the market is making lower highs, it is not a sign that the market is turning. Now what we get is a first higher high. So when we look at this downtrend here, you can see you have always lower highs until here. Now the market is for the first time pushing into a higher high, breaking this swing point. We also have the fake out, remember, and we have the strong demand area here. So this looks like a really interesting breakout scenario. However, I would caution you not to trade breakouts. They are not as reliable. And especially if the price is coming from such a strong run, the likelihood of a reversal or a pullback is quite high. So what I'm doing in my trading, I'm waiting for a pushback into the breakout area. And we can see that here the market is pushing back. It is the inevitable pullback that we have been waiting for. And especially after such a strong move here, you are expecting a pullback. And if you're trading the breakout, you're immediately running into the pullback. You are sitting on a loss, and that's not the ideal way to start a trade. So instead of trading the breakout, wait for the retest, and especially important, wait for the market to turn around and move back into the trend direction that you want to trade in. A lot of traders make the mistake and go long when the market is pulling back here, but this is not correct. You want to see the market actually make the retest move and push into the direction. And you can see that the price is shooting higher. If you trade such a retest, assuming we get it in somewhere around here, your stop loss generally can be considered here below the last swing point. And then when you're trading with the trend, you can look left, look for any structures on the left, important support and resistance levels, and use them for your targets. And because we're using a trend following approach here in a new trend, very often you will find good reward to risk ratio trades. No matter which trading book you read or which trading podcast you listen to, a trading journal will always be mentioned as the most important trading tool a trader needs to have. That's why we developed the Edgewonk Trading Journal. And currently we run a promotion. So for Tradeciety followers and fans, go to edgewonk.com, and when you buy your Edgewonk Trading Journal, use the discount code Tradeciety to get the biggest possible discount. Now with the next example, let's take a look at weakening highs and how we trade trend reversals the right way. So when we look at this chart on the left side, we can see an uptrend. We have a higher high, another higher high, and then another higher high. And then from this higher high to here, you could say you're making another higher high, but this is really weak. And when you're looking at trends, it's really important that you start paying attention to the high structure. Are the highs and the distance between the highs, is it strong? Is there a large distance between the highs? Is the market rallying up very strongly into a new high? Or like in this case, from this high to here, it takes the market quite a while. And also obviously it's not really strong because the market just barely advanced higher here. Afterwards, we see our first lower high in the making. And clearly this is now a structure where we could say that the trend dynamic is changing. Whereas here we had a lot of movements and strong forces into the bullishness, here it's seemingly changing. We also can draw a very good support level here, connecting this low and this low. So the market is still making higher lows here when we look at this low here, here, and here. Those are all higher lows, but here you can see the market is making equal lows. As long as the market is not trading into a new lower low, I would not say there is a reason to go short. We do have now signs that the market is weakening and we can start looking for short opportunities, but as long as the market is not fully breaking into a new lower low, it's too premature. What you can also do is add a moving average. This is a 50 period EMA. So an exponential moving average, it's great for trend trading. And you can see that the market is still trading above it. So now we have two areas of confluence that we can use for our trading. We have the low support area here, connecting the two lows, and we have the moving average. Generally speaking, when you're looking for a trend reversal, you want to find multiple reasons to short a market. And we see that here. Very strong breakout here through the moving average. The moving average is also starting to point downwards. The market is very aggressively here, moving below the low point. And when we look left, you can see this is the strongest bearish sequence of candlesticks that we have seen in this uptrend. We do have occasional bearish candles here in the uptrend, but never that strong and never that prolonged and never on such an important area on our price charts. When we look left, we can target previous support areas. And what we're doing here is we are trading a trend continuation in the downside. It's very early, granted, it's a very early trend continuation, but it's not a real reversal. A real reversal, I would say, is when you try to predict when the market is going down before it's actually going down. But here the market started to go down, and so we are very early on in a new downtrend. And that is then when we go to the left, we can look for a support area. We pick a very wide target for a good reward to risk ratio. And then the market is trading below the moving average to the downside. One thing to keep in mind here is that you don't need to be early in your trades. A lot of traders try to pick tops and bottoms, but then they run into a lot of false signals. And it's not necessary to pick the top and the bottom. Staying away from a top like this and trying to predict the market turning to the downside is a very risky business. Instead, get into the habit of giving up this first third of the trend. The first third of a trend is not where you want to participate. You want to go for the little bit of a safer part in the middle of a trend. So we stay away from the first part of a new trend and we go for what is in the middle. And that is typically where you find your high probability trades. Now we look at a conventional trend continuation with a pattern entry. So when we look at this, we can clearly identify the bullish trend here. When we look at the highs, the market is making higher highs. When we look at the lows, the market is clearly making higher lows. And how do we find entries now? That's the question. Finding continuation signals into a trend is often not that simple. And the answer is that we are waiting for a well-defined pattern. The clearer you are on what you're looking for and the clearer the pattern, the more repeatable the process is. And that's what it's all about. You want to find repeatable patterns so that you can build a trading strategy around it, you can build rules around that, and then keep trading that pattern day after day. The more clear you are on how the pattern is looking like that you're trading, the better it is. What we see here is that on the way up, the price keeps retesting previous resistance, right? So we have a high point, the market breaks it, comes back, moves higher. The market breaks the previous resistance here, comes back and retests it. And then when the market is pushing into a new high, like it's doing right now, we can identify a cup and handle. The cup and handle is defined by the cup part, which is here the first swing point or the swing part. And it's also here the bottom of the retest. And then the handle part, it's where it gets really interesting. The handle part shows us that the price pulled back away from the previous resistance and it immediately shot up again higher. So at this time, there is no bearishness in the market. The bearishness was here very, very obvious. The bearishness took the price down, but the market bounced here. This time, the market moved lower, but the buyers stepped in immediately, and there were not a lot of sellers in the market here to drive the price down further. And that shows us that the buyers are really dominant here in the market. And you always want to look for those little clues, how the price is trading into a level, around a level, away from a level, and then here the strong breakout is ideal. At this point, this is a high probability long entry, and then you can see the new uptrending phase is started here after the cup and handle phase. And this is how you find good trend following entries. Now let's take a look at the concept of breakouts versus fakeouts, because that's where a lot of traders struggle. What we see here is that the market on the left side has been in an uptrend. The market peaked here, moved lower, and is now coming back into the level. And what you can see is what I just mentioned. The market is coming back into the level sooner and sooner. And here we have a breakout attempt. Is this a good breakout attempt? I would not say so. First of all, it's very weak. The price is just barely able to crawl above the level. I would say you wait for one more candle for the price to pull into the trend direction before getting into a long, or even better, wait for a breakout and a retest before you go long. The retest signal is a much more high probability signal than the initial breakout. The retest shows you that previous resistance is now turning into support, just like what we've seen in the previous example. What we see here is that traders who go immediately long will have a stop run. If you go long, your stop loss is probably going to be somewhere in this area, and you now have a stop run. What we do is we draw a trend line, but I'm not a big fan of trend lines, they're quite subjective. So what I would do is I put a swing low level here. So I'm looking left and I'm asking myself, where is the last highest low point? The last highest low in this swing point is here. And what this means is that I want to see the market break into a new swing low. When the market is making a swing low, it's a high probability signal that the market is showing more bearishness. Usually swing lows are defended by buyers. What this means is that the price in an uptrend is generally not able to break below a swing low point. If the market is now able to close below that, it's a high probability signal, especially with the context that we have seen here. The market is not able to break through the previous peak here. It's a lot of weakness that we can see here with the fake out. And that means if the market is able to get below that, we are looking at a very, very good signal. What we do is we go from the 4-hour to the 15-minute to observe the breakout of the swing point. So here, last swing low refers to this level that we have drawn on the higher time frame. And what we see now on this intraday time frame, the 15-minute, is we have the breakout and the retest and the continuation. And this is where you find high probability shorts. We can look at the fake out that we've seen on the higher time frame. This one, keep in mind, it's this area here on the lower time frame. Here we had the breakout and no retest. The market started to make lower highs here on the lower time frame. But in this case, it's very different. We have the breakout, the retest, and the market is then successfully pulling away from the level. This is a high probability scenario. We have the higher time frame on our side that is showing us bearishness. We have broken here below the last swing point, and we get the break and retest entry. So this is a high probability short entry. And you can see this was the short entry. The market moved lower very, very strongly away from the top and into the new downtrend. So now let's take a look at a different example of a continuation and the concept eating the wick. So here we're looking at a strong uptrend, right? The market is moving higher and higher and higher. Here we reach a peak. From the peak to this area, we see very, very strong selling. So you can see from here to here, this is the strongest selling that we are observing in all of this uptrend. It's a first important clue that the market might show more signs of bearishness. There's probably also a lot of profit taking going on here. And we want to observe how the market is reacting to this strong selling phase. First, we can see the market is pushing back into the highs, making another double top. Then the market is selling off, this time not as strongly as before. It's rallying back into this area and it's not pulling away a lot. We have to observe now how deep this is going to be. If the price action now is able to break this swing low, that would be quite a significant short signal. But as long as the market is able to hold above there, it's still leaning more on the bullish side, because when we look left, what has happened? We are in a bullish trend. We cannot forget that. A lot of traders make the mistake of always being in a reversal mindset. This is not good. You don't want to have a contrarian mindset. You want to see what is going on here, and clearly the market is in an uptrend. Therefore, as long as nothing is changing here on a trend perspective and the trend structure is not broken, we remain in a bullish mindset. Here you can see the market never broke here, swing lows, the market kept making higher lows, and we have the strong breakout. A lot of traders will get scared here about the wick. I don't think this is justified. I've been trading for 15 years, and over the years I've recognized that wicks are not really that bad and you should not be scared of them. Acknowledge them, but they are not necessarily a rejection signal if they occur in the right context. If you get scared of wicks, what I would recommend, look at how the market is responding to the wick. A lot of breakouts will then eventually eat the wick, which means that the market is moving higher and higher until it covers the wick. And if the price action is able to take out a wick, then the continuation likelihood is super, super high. And this is what we see here. This is the wick breakout candle. We have two candles which close really strongly. At this point, the market has eaten the wick and has fully covered the wick, and then the market moves higher. So if you are a conservative trader, you could wait for this eating the wick signal, and then with time you will start to recognize there's nothing to be scared about when it comes to trading wicks. You might be able to get in earlier and earlier on the breakout, but of course there's nothing wrong with waiting for the market to eat and consume such a wick.